But we also have the Fed trying to tighten into this, which is bad for pretty much anything other than the dollar and maybe some really defensive value types of equities and things like that.
Before we move forward, I'd just like to remind you that we're giving away $100 to a random subscriber at the end of this month. To take part in it, all you have to do is subscribe to our channel, like this video, and leave a comment in the comments section below. Good luck. Now coming back to Lyn Alden's interview. In this one, she talked about her latest predictions for Bitcoin, and then she compared it with gold. She then talked about other altcoins like Ethereum, and said that the current markets don't look as bad as everyone says they do. But still, she issued a massive warning against risk assets like Bitcoin, and said that assets like Bitcoin are better buys during a risk-off environment. If you want to hear Lyn's comments on the crypto market, watch this video till the end, and don't forget to press the like button. Now, let's look at her interview.
Well, so in the prior few years, we saw, one of the biggest ever liquidity injections into markets in history. And now we're seeing one of the biggest withdrawals of liquidity from markets in history. And so it's unsurprising to hear that there are rather extreme anecdotes happening, because we are seeing that show up in some of the numbers. I mean, the valuations that unprofitable tech stocks reached was comparable to the dot-com bubble. And the drawdown that many of them have had since then has also been comparable to the dot-com bubble. Back during the dot-com bubble, it was not like every sector was affected equally, right? I mean, there were a lot of the value sectors. I mean, they might have run into a few years of market turbulence, but they didn't have the extreme, price movements and liquidity movements that you saw in some of the tech names. And we've kind of seen a similar outcome this time, where what you see in tech and venture is like one of the biggest boom busts ever, whereas what we're seeing in many other industries is not nearly that extreme. And I think what's also adding to it is that we have a historic bond drawdown at the same time, whereas in most of these environments you would have seen bonds do pretty well, and so a lot of investors have stocks and bonds, and they both went down. And so based on something like a 60-40 portfolio, you actually have a drawdown similar to what you see in 2008. Even though stocks, in terms of the broad indices, have not done nearly as poorly, at least as of this time, as what they did in 2008. So a black swan is pretty much by definition unpredictable, right? And so there are low probability events that occurred. Like, I mean, I think the Russia invasion in Ukraine. I mean, the idea that it would happen right now this year was surprising to many, including myself.
Yeah.
So there's a number. I mean, the timing of the pandemic, a few years ago, things like that are possible to have in your kind of near-term models. And so there have been a number of shocks to the system, but there are always shocks to the system. Some of what we're seeing in this broad drawdown are not black swan events. And so, for example, if you look at the U.S. Purchasing Managers Index, right, the PMI is basically a measure of economic growth acceleration or deceleration. And that doesn't mean growing or shrinking. It means accelerating or decelerating. And of course, if it decelerates enough, it can outright shrink. And if you look at that long-term cycle, roughly every 3 years, you go through one of these gyrations where it looks like a sine wave with like a 3-year period. And, some of those drawdowns result in recessions, other ones result in soft patches. Whenever you have a declining PMI environment, which we've had over the past, 6 to 12 months, you tend to get a lot of these impacts in the system. And then we complicate it by the fact that we had the biggest inflation spike in decades. And so the Fed is tightening into that slowdown. And so a lot of things that are inherently unstable get tested and broken. And what we're seeing in crypto, I mean, it's always hard to say what specifically is going to happen. But for example, the biggest news event there is the complete unwinding of the Terra Luna ecosystem. And there are a number of us, including myself, that actually wrote ahead of time about the risks with that protocol. And so, I didn't say it was going to crash in mid-May. It was like, it's like, if you're worried about forest fires, you can describe, the conditions for a forest fire are looking very problematic, but you can't predict when lightning is going to hit a tree, right? Yeah. And so there are a bunch of people that are outlining there are aspects in the broad crypto space that are completely unsustainable, and that can be separate from your long-term view of something like Bitcoin. But basically around Bitcoin, there's all these other projects, and many of them are, basically they seem like black swans when they happen, but they were artificial to begin with. Yeah, Russia had a lot of strong things going for it going into this, right? Like as you point out, they have low debt, they have high foreign exchange reserves. Basically being a commodity exporter was really good going into this environment, and obviously they have some structural issues related to demographics, related to their levels of freedom and things like that. I think they could certainly use some reforms, but overall, I mean, they were pretty well positioned. And it's funny because, Russia's had this long-term history of being invaded a number of times. And so there's a lot of people that pointed out that they have certain geographical concerns that they want to manage, but they're a nuclear power. I mean, they're at no risk of being invaded or anything like that. And so if anything, this has decreased their level of security going forward. And so I think that was surprising to a lot of people that they would take such extreme action, even though there's obviously tensions there. And so, we'll see how this shakes out. Obviously, Russia has a lot of, they have a stronger hand than I think the West realized, because of course, Europe is very heavily reliant on Russian energy, and globally, I mean, fertilizer markets and nickel and basically there's so many commodities across the board that if you just took Russian outputs out of that equation, it'd be a catastrophe. You'd have famine. And so basically they have a very strong hand. So does obviously NATO and the peers there. And so this has certainly added a lot of volatility and tension to the markets. And for a while I've had the 1940s comparison where the 2020s were a lot like the 1940s in terms of fiscal and monetary policy, as well as social change, things like the fourth turning, wealth concentration, rising populism. There's so many things that were aligned. And I was hoping that we wouldn't see a kinetic war. I was hoping that wouldn't be one of the areas of comparison, but unfortunately that's, during those types of big changing periods, you often do see, unfortunately, that it manifests in kinetic war. Well, we have been seeing a shift back to value and commodities in particular. That's been very strong. You've seen like a huge rotation from tech to energy, for example. Year to date, gold is doing better than both stocks and long duration bonds. So it might not feel good to gold investors because you don't see gold really going up and gold stocks going up, but gold in particular did outperform a lot of the risk assets. And so it did its job in a challenging liquidity environment. I think to see gold do particularly well, you'd want to see more, right now, so basically we have a declining economic activity, which is generally good for gold compared to stocks. But we also have the Fed trying to tighten into this, which is bad for pretty much anything other than the dollar and maybe some really defensive value types of equities and things like that. And so I think right now the Fed's in a dilemma where they have declining economic activity, but inflation's still well above their target. And so I think the regime shift would happen if they have to stop tightening due to declining economic activity while inflation's still high. I think that's where you could see gold do particularly well. Probably some of these other, Bitcoin probably do pretty well. Whereas anything that still faces margin pressure from rising wages or that faces supply chain problems from, say, China, those things would probably still continue to have some turbulence in that type of environment. Whereas the things that don't have to worry about profit margins, like hard monies, can do pretty well. And then I would say furthermore, I think, obviously one of the challenges to gold has been that it's now sharing the market with things like Bitcoin. And then even the broader, even Bitcoin then had to share that with like Ethereum and had to share it with all these altcoins. And when you have every few years in that cycle, the malinvestment's cleared out, right? So anything like Terra Luna and these other things, they get cleared out. And so, I think if you were to look at gold and Bitcoin together, that's not really been a weak market over the past, any really decent time period, 3 year, 5 year, 10 year. If you have a little bit of both, gold does better in kind of risk off environments. Bitcoin does better in risk on environments. You don't worry about the market share dilution as much. I know that, for example, the folks over at Incrementum, they published the In Gold We Trust report. Yeah, I know they have it's like a fund that rebalances between, say, gold and Bitcoin. Right. So they've kind of expanded their view of. So I think, if you look at it in that lens, it's not really been that bad of a market for hard monies in general. So going into this year, my focus is generally on being diversified, but then tilting to whatever I think is more attractive. And so, I was kind of highlighting that as the Fed, stops their balance sheet expansion, as they try to tighten, as PMIs roll over, that's, rather defensive environment. And I was upfront and saying, like kind of like that analogy I said before, like you can show conditions of a forest fire, but you can't predict, where lightning is going to strike. I was basically saying, I don't know if we're going to get sharp drawdowns or if we're going to stagnate, but I think that risk assets in general are going to have a tough 2022. And so I was leaning defensive. I was kind of emphasizing healthcare stocks, energy pipelines, energy producers, maybe a little bit higher cash or tips position, gold. And so that doesn't mean I don't own other assets as well. But I was basically emphasizing some of those defensive assets that historically do better in falling PMI environments. And I think we're still kind of in that camp. I think a lot of that's already played out. We've already seen complete turmoil. Basically, it's more bearish than my base case would have been, but it's in line with that defensive type of view. And I think that the further it plays out, the more we can go back and look at some of those other assets, right? So some of those really, you can kind of, let's say you look at ARK stocks, for example, 5 years from now, a lot of them were just inherently bad companies, but probably some of them will bounce back and be stronger than they are now, right? So you can kind of, I think that's a market where it's been totally devastated. And so you can go in there and see maybe there are some babies that were thrown out with the bathwater and say, okay, when we do see a Fed pivot, these are the names I might want to have exposure to. So I think we can start looking at the other side of that. But basically, as long as you're still in a falling PMI environment, as long as the Fed still try to tighten, it's hard to really get too much risk exposure. Any sort of tight commodity markets are not great for human flourishing, right? I mean, obviously you want an environment where supplies are very abundant. Whenever they're scarce, that can be really problematic, especially if the scarcity is due to supply side problems. So in the 2000s, obviously you had a commodity bull market, but it was very much demand driven. Whereas, in the 70s and here in the 2020s, it's more supply driven. And so that's a very unpleasant environment for a lot of people. And so I continue to have a bearish view on basically I'm kind of bullish social unrest, you could say, right? I'm bearish, peace, you could say. And that's unfortunate because obviously a lot of people suffer from that. I've made the recommendation to my subscribers, like in aside from the investments, to consider making sure, your personal life, that you are well stocked, right? That doesn't mean being a full on prepper with your bomb shelter, but it means basically the supply chain is so lean. It's so, there's low inventory. There's, basically it's always like just in time delivery. And so it's kind of on households if they want to have some degree of margin of safety there and some degree of stockpile. And so I think this is an environment where you, in addition to managing your portfolio, you do have to manage your exposures to various things you might need over the next 3 to 6 months or 12 months, how much you want to have. And so I am still very concerned with a lot of things we're seeing in markets.